Hello and welcome everybody to this week's Middle Class Investor. This is Seth Martin. It is 14th of April, and we had a down week in the market, as you can see here. It's indicated by this red candle. We've this downward move has been somewhat slower than I anticipated actually, and it's kind of creeping its way down and slowly making its way. I think ultimately probably this area right in here. You can kind of see, and this is good review because it just helps you kind of get used to seeing the market move a certain way. But you can see we had a little ABC there, and that could have been the first move. In fact, I was thinking that was probably, counter trend to this move up, but this first little ABC broke the trend line, which tells me it's part of the larger trend. So, and then you can see we kind of rallied back up to here, and then you could have another kind of an A, B, and then a longer C down into this area. That's one scenario. So around 22, well, it says 2257 here, but I think I was looking at some more precise areas around 2280. And then, of course, we would expect at that point for the market to rally to new highs, back up to this trend line area right there. So depending on how long this takes, it could be right here, it could be, maybe even a little higher, but not a lot higher than this level right here, because this last move up will be a wave 5, and wave 5s are generally pretty weak. They don't typically extend past the previous wave 3 very far. So when we start getting to this old high back here, and this move up, this is where we want to exercise a little caution, maybe take some money off the table, those kinds of things, because once this finishes, it's going to be, we should see a pretty dramatic move back down. I mean, nothing like this multi-week, multi-month thing. I'm talking about like really fast, maybe a couple of weeks, having this come all the way back down in this area really quick, and maybe further. So anyway, now there's another potential. There's one other potential under a corrective scenario, is you get, kind of a move here. Whoops, I didn't want to do that. You get this move down here, which was an ABC as we just drew. So I'm just going to draw it as one move. And then this could be A, B, and then C. Whoops. My little tool's not working correctly. This could be ABC up, maybe to there. And then we get an ABC back to here. And then an ABC to here. So in other words, you get an A, B, C, D, E, which we call this as a triangle, and then a rally to new highs. So it's hard to see that that's a triangle, but if you kind of connect this area to this and this area to this, you can see that that's a triangle. And a triangle is just a continuation pattern. So if the trend is in this direction and we get a triangle, then we know the way the triangle is going to resolve itself is to the upside. So, but you should expect to see a triangle is a sideways pattern that's made up of some ABC. So ABC, 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 and then 1, 2, 3, 4, 5 up here. So hopefully everybody understands that. But at this point, to me, it looks more likely that This is more of a zigzag correction where you have a WX, what's called a WXY. So you get A, B, C, and that's W. This is all Elliott wave jargon. Don't worry too much about it, but this is X. And then you get an A, B, C, where C is a wave, a 5-wave move, and this would be Y. It's called a double zigzag. WXY, so ABCW, ABCX, ABCY. So hopefully that makes sense and to give you a sense of what to look for. But I think if you're considering, moving back in to a long position in this market, I think you wait a little bit because this really hasn't pulled back sufficiently. Just to kind of give you an idea, this part of the trend that's pulling back here is proportional to this area right. Let me just zoom in on the whole trend here. So this is the whole trend here. It started back here. And I zoomed in too much. Let me zoom in not so much. Maybe like that. And then zoom in. That way you can see the whole trend. Well, you can almost see the whole trend. So it started back here at these lows. And this is all one trend, okay? Up to wherever it ends up, okay? But the part that's is proportional to the part that we're in right now is this this area right here. So if you look at how long this pullback lasted, it went down, rallied up, went down again. Okay, so let's back up and let's see how long that lasted. So that's this area right here. It lasted from about August 1st to October 31st or November 1st. So September, October, November, talking about 3 months. So we should expect this to be about 3 months as well. And it started in, let's say, the end of February. So let's say, let's just call that March. So April, May, June. So in other words, sometime around the end of June, this move should be completed and we should start rallying back up. So that'll give you a kind of a time frame to look for. The summer months are usually weak, so this would play right into that. A week advance up to a new high, and then probably a big sell-off after that. So hopefully that makes sense to everybody. Of course, if you want any clarification, just put a comment in the comment section, and we can correspond that way. All right, let's look at the 10-year yield. I've said many times this is the most important yield in the financial markets, and you can see we kind of touched that box last week, but then this past week we drove right back down into it, and I'd say likely we're going to fill that gap. So let's say this is the first move in the correction. So let's kind of draw out a scenario here too. So this is the first move in the correction. So this would be, let's say A, and then next couple of weeks we get a bounce maybe that looks like that, and then we get C that would close this gap and then some. Could run as low as this line here, or it could stop, somewhere more in here and then rally. And we should get one more new high in the counter trend move on the interest rate. So so really this is kind of mirroring the market. We get a pullback and then a rally to a new high, and then except this is likely to go opposite the market. So if the market, while it's true that if the market sells off, this should pull down, that'll only be temporary. Because as soon as we hit this point right here and we start going higher, people are going to start jumping out of this bond market like crazy. So let's look at the short-term yield. This is the 13-week Treasury or the 3-month Treasury. And you can see, just like we've been saying here, we got another breakout Now the short-term yield is 0.79, and if you go into your banks, you're starting to see the banks, even though we're waiting on the Fed to actually raise the rates, the banks are already starting to move. They're starting to offer, 3% yield, 2.5% yield on your checking account, things like that. If you don't know about that, you might step into your bank and look, or you could just wait for a better deal. I mean, these deals are probably going to get better and better on the money that you have in the bank. So, but clearly the market is leading. This is all market. This doesn't have anything to do with the Fed. So the market is leading interest rates higher, not the Fed. We've talked about that extensively here. Let's look at volatility real quick. Volatility still remains low, although creeping up and into this box. My guess is we'll probably volatility get maybe as high as this 25 to 27 area, and we can put a box there just to keep ourselves honest. So let's say from here to there or so is where we're looking for, or is where I'm looking for volatility go to. So we'll keep an eye on that. Move this out of the way. We can look at some of these other markets like Germany. Here's Germany. Germany's making its way up. We talked about how this looked kind of counter trend, but this could also be kind of a 1-2, 1-2. And now Germany's going to make its way up into this old new high ground. Japan, I think Japan's even a little bit more ahead of that. In fact, it looks like it just touched my box up here. I would say it's probably likely to go higher, maybe more in the middle part of the box. We'll keep an eye on that. The UK, this still looks weaker compared to Germany and Japan. So you UK guys, in fact, right in here, I would start looking for, the UK to roll over. So this high right here is the key high area. So let's just put a box kind of above that, and you can see we've already hit that box, and it might make a new high and roll into this box a little deeper, but then we should see the UK roll over after that. All right, let's go. Yeah, I forgot to preload this. Let's go over here to oil and commodity markets, gold, silver, things like that. You can see we're going to retest this box area. We got up into there and pulled down and then kind of going back in there. But shortly here soon, we should see oil begin to roll over and start making lower highs and lower lows. So if you were thinking about investing in oil companies or anything like that, you might want to wait a little bit. Now, the big picture in oil, this could be a wave 4, it could be a triangle, but the really big picture is, let's put it up on months. We've got an A, B, C in oil and likely to pull back into this 16 area before this counter trend move is finished. There's really nothing more to say about that. Now, when oil does take back to the upside, it's going to move pretty rapidly, and we're going to see oil work its way up to these old highs around 145, 150, and it's really going to damage the economy. But the thing about it is this is not what's going to drive oil higher, demand and supply and all that stuff. Really what's going to demand or drive oil higher is just a decreasing dollar. So the dollar's been, and I don't know why I don't get the dollar anymore. I need to look into this. /DX doesn't come up in my system anymore, but the dollar is making its way higher still, and should get to new highs and should stay there just a short amount of time, just long enough to suck a bunch of people in and then roll over and make people lose money. So this is the euro US dollar, so it's the opposite direction, so it's going down as the dollar's going up, and I think we still got a low in below these old lows for the euro US dollar. All right. Of course, we could look at other currencies too, the euro, Japanese yen. We could look at British pound, and here's the British pound US dollar. Continues to fall, likely in an ABC. I mean, they're probably related. I mean, certainly they're all related because they're pairs that are traded against one another as interest rates in foreign countries and trade balances shift to and fro. These currencies make adjustments. All right, let's look at gold. Gold is having a good rally here. I think it's up 25% since January. I think the overall market is only up about 3% since January. So gold was a much better place to be at the beginning of the year, and continues to look strong. My guess is gold is going to retest these highs and probably get up here around 1400 or so before it rolls back down and continues lower. Gold is in an ABC here, this being A, this area up into here being B, A, B, C. Now this could just be A, B, C, W, A, B, C, X, and then A, B, C, Y. And then that would complete, let's see, that'd complete the wave B. So this would be A, B, and C down. But once gold gets down into this area, really anywhere below 1,000, you ought to consider being a buyer, or 900, let's say, of actual physical gold. Because if the dollar, and it's likely to happen, if the dollar starts losing value, gold's really going to be the only thing that will protect you. That or real estate. You could go out and buy some real estate. The problem with real estate is you have to pay taxes on it. So, you can buy gold and you'll have to pay taxes when you finally sell it, but you don't have to pay taxes every year to some local, municipality. So real estate, yeah, it's appreciating, but you're also having to, it costs you money to own real estate. Whereas gold, I mean, if you store it yourself, it really doesn't cost you any money. It costs you money to buy it. There's a commission to buy it, but there's a commission to buy land too, right? You got to pay a real estate agent. But gold is always traditionally the reason you buy gold, among others, is just in case the currency starts to diminish in a way that starts to eat away at your savings. And I don't know how many of you are paying attention to what's going on in Venezuela, but if you go to YouTube and pull up Venezuela crisis and watch some of those videos, you can see how something like inflation just ravages an economy. Now, I don't think the United States is going to get as bad as Venezuela, but generally speaking, people in this country have more debt, they live more paycheck to paycheck, and you throw some inflation on that, and well, that really creates some desperate situations. So just consider it maybe. Again, let's look at the long-term picture here. This was the run up from 1999, which is likely a wave 1 in a very large degree trend. So if this is 1 and 2 pulls back to here, we're going to see 3 go a long way and very, very high, probably into $3,000 to $4,000 range, maybe $4,000 to $5,000 range even, before we even get a pullback. So keep an eye on gold. Consider buying some here below 900. This is a pretty strong support area right here. Let me zoom in on this and talk about this. So in this run up in gold that went all the way to here, one of the reasons I drew the box where I drew it, sorry, I'm trying to get this situated just right, is because of this support area right here. So this is a pretty strong support zone, and so likely makes a good spot as a target for this larger trend resuming upward. So that's one of the reasons I drew the box here, is when you see, a pullback like this, it's pretty strong, and it looks like a zigzag. That is a pretty good area to call support. So support's just a region or an area. It's not an exact line. So somewhere in here you have to, once it's pulled back into this area, then you have to have kind of a discipline around, well, where do you enter? And I've covered this before on here, but we can cover it again real quick. Let's say this were pulling back into here, okay? And let's say you got a candle that looked kind of like this with a long tail on it. And this could be a daily candle or a weekly, but let's say it was a weekly, because that would be a more conservative entry. And let's say the following week closed and looked like that, maybe with a small tail here and a small tail here. So this would be your low week. You pull back into a low. This is it's called a hammer, where you have a real long tail on it like this. And then the following week, you pull back a little bit and rallied above and closed above the hammer. Then this combination of candles would be an entry signal. Now, it is true that the following week might be down slightly. Might pull, all the way back to something like that with a tail here and a tail here. But what you're really focused on is the relationship between these two candles, this first candle and this one here. Now it could pull back and actually come back and make a lower low, causing you to lose money on this entry. But more times than not, what happens is you get right in here somewhere, you get a really strong candle, like so, like this. And you actually get a series of them. Maybe one's kind of weak looking, like so. And then you get one that kind of looks like that. So this is why this is such an important signal to get in. The key is you want to be patient and let your downtrend. You're looking for proportion, right? So the size of this downtrend needs to be sufficiently large so that it makes sense in the context of this uptrend. Okay, so in other words, you wouldn't be looking to enter here necessarily. I mean, it just depends on, this is gold, right? So we're going to go buy physical gold. So we don't want to enter here, because this pullback here is not that long compared to, this 10 years worth of data here. So we may have another 2, even 3 years of a pullback here. It looks like, it started in, what is that, 2011. So 2011 to 2017. Well, let's say to right here, that's 2015, 2016. So this right here took 4 years, and then this move up looks like it's going to take what? Maybe 2 years. 2 years for this move to go up, and then who knows? Maybe we got another 4 down from here. So 2 years from now is 2019, and then 4 years from 2019 is like 2023. So we're not going to see these lows down here until like 2022, 2023. So but I've talked about this before, and why I thought it was a good time to buy right in here somewhere is because it could get all the way down here, and then once people understand, okay, this is what's happening, then you might start having supply issues. So producers, as these prices are going down, producers are less likely to produce more gold. They're more likely to produce less gold, right? So there is actually a market. So stocks don't move that way, but commodities, there actually is a market, a real market for commodities, and there are real production considerations and real, do we even produce gold at $600, an ounce, or $800 an ounce? So those kinds of things will impact the availability of physical gold if you did want to buy some. So what I was saying back here is, if you want to buy some right here and then wait to see if you can buy some here, but you may or may not be able to. Maybe you can buy gold here, back here at $700, but maybe the commission is no longer 2-3%. Maybe it's 8 or 10% or 20% even, because the demand is so high. So, what have you done? You could have bought it here for, say, a 2 or 3% commission versus buying it here. So yeah, you save money, but you paid more in commission. So maybe it's a wash. Somewhere in here it's a wash, right? If the commissions are going like, if the commissions are moving like this, when they start doing this, and then the supply of gold is doing this, then somewhere there's a break even, right, where these two cross. And that's all I'm saying. If you try to wait, and don't get me wrong, I'm gonna try to wait and buy some here too, but I already have some. So at a fairly low commission, I bought some right in this area, somewhere in here. Actually, I bought silver, so we can go look at silver, and I'll just tell you where I bought it, or show you where I bought it. Silver is SI. So let me zoom in on this. So right in here is where I bought silver. So I think it was about $15.15 or so. So I bought silver. So in other words, I was watching this pullback just like we do each week here. I was watching it really close in here. You can see I got some lines drawn on the page and stuff. I was really trying to get, hone in on the. And so what I ended up doing, I think I ended up buying some during this green candle here. I don't want to say it was around 15.15 or something. And it ran up and I felt like a genius. And then all of a sudden it pulled back and went even lower. And technically I could have bought some down here around $13.50. So I wasn't as much of a genius as I thought I was. So, you got to really, picking the actual bottom is very, very difficult in any market, any financial market. So, but in retrospect, I probably should have waited till this. You can kind of see how this 30-day moving average, is this the 30 or I can't remember which one this is, but this moving average, maybe I need to identify that and let you guys know. Maybe it's a 5-day moving average, which in this case is a 5-month moving average. But you can see it started to curl up, and maybe that would have been a better time to actually see it curl up, find a low with a break above the low, and buy here. And so maybe I could have got it. Maybe I could have saved myself 35 cents or 40 cents an ounce, which in retrospect is not that much. So I'm not really worried about it. And like I said, silver's likely to go back down into this area anyway. So I'll get another stab at it down here below 10 and probably buy more of it. In fact, I don't know if I'm going to buy more silver or if I'm going to, because I bought quite a bit of silver there, but I might just buy gold, 1/10 of an ounce coins or something like that. So anyway, that's probably more than you want to know about it at this point, but I just want to, I want to help the people that listen to this, and I know there's not many of you, but the ones that do listen to it, I just want to try to, give a little background, a little understanding of, how to approach the markets. Trading markets on a very short-term basis, like on a 5-minute chart, is very difficult because, it zigzags around. You can't really see these patterns. But when you're looking at, a month chart, and you hit these very important lows, like, 01 was a very important low in silver and gold. I think it actually hit a low in gold in 99. Let's look at gold. Yeah, 99. It was a very important low. So that would have been a good clue too. You know, see gold hit a low, see it pull up, pull back to a higher low. Then you could have run and bought silver right in here, and you would have bought it almost at the low. So um, anyway, I'm just trying to give you some context so you can approach the markets differently than I don't know what's going to happen, but I'm gonna buy gold right here. Well, if you buy gold right here, $1,300, you know, just know that it could go all the way back to say 650, and you're still right. You still potentially could be right that gold's going higher. Okay. Well, who wants to buy gold at $1,300 just to see it go all the way back to 650? I mean, wouldn't you rather try to buy it closer to 650? Is my point. So it's important to understand, you know, proportionality, you know, corrections and proportionality of corrections, um, and also to understand that these are very, very long-term trends. And so, you know, otherwise you wouldn't want to buy physical gold or physical silver. Uh, if it's a short-term trend, you could just trade it. You could buy GLD or something and trade it for a year or two and make some profits. But what we're looking at here is if gold really does go to $4,000 or $5,000, that means the dollar is going to be worth like less than the toilet paper you use in your house. So, you know, we could be headed for a very serious dollar crisis, and the only way to protect yourself against that is to have something that you could trade with people. Because when they quit taking dollars or they start weighing dollars instead of counting them, you're going to have something else to trade for food and rent and cars and things that you need. So anyway, I hope that helps you guys understand that a little bit. I think I closed it down. I was going to show you an Elliott wave shot of the bond market, but we could do that another time. I think I'm going to go ahead and stop there. I feel like I'm rambling a little bit, so I'm going to go ahead and stop there for this week. But you guys, you know, be sure to come back next week. We've got, you know, the market's at some critical junctures. Let's say by June or July, we're going to be looking for a bullish move, and you want to make sure you catch that. It could be a little sooner, but probably not any sooner than June. And you want to make sure you catch that. But then you really need to watch because you want to get out. We don't want to be in when it starts getting too much higher than just a new high, because the fireworks are really going to get started. And you don't want to be the way I kind of look at it is like a train coming down the track. You do not want to be standing on those tracks when we hit a super cycle degree trend change. I mean, that's just going to bury you. It's going to bury a lot of people, and it doesn't have to bury the people that listen to this program. All right, everybody, thanks for coming in, and we'll see you next week. Take care and have a happy Easter. Happy Easter, everybody. Bye-bye.